An assassin's bullet almost kills former President Trump. Treasury markets are telling us there may be even more inflation on the way. If the Fed did start to cut rates, what would that mean for investors? Those topics and crypto investing on this episode of Investment Insights from Opal Capital. Thanks for tuning in to this episode. My name is Jay Coulter. Joining me as always, Adam Muller and Austin Graff. This is a special episode. We're recording this live in front of the team at 49 Financial in Austin, Texas. Let them hear you guys. All right, guys, let's start with a recap of what's happened here recently in the markets. The stock market notched an all-time high this past week, posting its 10th weekly gain in the past 12 weeks. This week, small caps have been on a tear. The outperformance of equal weight indexes versus cap weight indexes is starting to show its stripes. What we want to know is that a trend that's going to continue? And the CPI report indicates that inflation is on a glide path down towards 2%. What does that mean for the markets? Adam, what are your thoughts?
I mean, it's been a fascinating week, right? Because all year we've been talking about how the Magnificent Seven have been driving the S&P 500, the semiconductor trade, the AI trade. And this week we've seen maybe the first canary in the coal mine that trade could start to unwind. And the question will be, is this just a sort of a week of kind of resettling, or does this start sort of a dramatic shift in sort of the balance of the market?
Austin, what are your thoughts?
Yeah, I think really what we're looking for is something that shows us that this shift is more permanent. And so we've been hearing for a long time that valuations are stretched in opposite directions and there needs to be a rebound. And we've seen some of that rebound based on, events from the weekend, based on some changes in the treasury market. And in reality, we're not seeing enough of the underlying data, the more durable data change to tell us that that's going to be a permanent change. So it prevents us from necessarily adjusting portfolios too far in one direction. But we think that it could be kind of the canary in the coal mine, as Adam mentioned, like early signs in price action could lead some of those other data points to tell us that this could be a more durable event going forward.
Any thoughts on small caps this past week and the rip that they've had?
Yeah, I mean, it's if you haven't followed it this week, so the small cap, the Russell 2000 is up, 10%? And if you look at a chart year to date of the small cap versus the S&P, it was significantly underperforming. And even that 10% move, what does that makes up about a third of the gap. So if there is going to be a rebalancing, if people do think that the Fed is going to start to ease and rates are going to come down, and you might start to see some of these companies in a little higher, smaller companies, higher risk companies, not as strong balance sheets, companies with more refinancing risk actually start to get a bid relative to the large cap, stable, strong, brand name, Magnificent Seven type companies that have done so well year to date.
Yeah. Austin, any thoughts on small caps?
Yeah, there's a technical term we use here. It's called the dash for trash. And essentially, it's any company that's on questionable footing, has poor financials, has really been pushed down from a valuation perspective throughout the year, as people didn't expect them to be able to refinance their balance sheet. And now, because the Fed said they may reduce interest rates by 25 to 50 basis points, that's 0.25% to 0.5%. That's very little, right? Because they may reduce interest rates, all these guys are now in the clear. It seems kind of ridiculous if you sit back and think about it, but the market gets really excited, really emotional about these events because it's where technically the money's flowing. You have a lot of money in some large companies, and then it flows into smaller companies. If you got a lot of money chasing little stocks, they tend to go up a lot, regardless of if the fundamentals support it or not.
At this stage in the game, does that make you think through any potential portfolio changes as you look out?
We tend not to be too far one direction or another if we don't have what we believe to be unique insights into portfolios. But it does make us a little less concerned about a small cap overweight, as this could be an indication of a much longer run. There are some analysts on Wall Street who generally analysts on Wall Street come up with these very, what would you call them? Like headline grabbing or headlines that are attention grabbing. And so one of the analysts came out and said he could see small caps going up 40% in the next month and a half. 40% is a pretty significant increase. You don't have to be overweight small caps to benefit from a 40% rally in small caps. So we don't need to be overweight small caps to benefit from that rally. We're just making sure that we're not underweight because if this trend continues, we think it could be a good driver for portfolios.
And you can't underestimate like the psychology in markets. I've always thought like it's the decision to sell something can be so much harder than the decision to buy something. And so, somewhere out there, there's people that very, very smart investors that bought NVIDIA 2 years ago and are sitting on 500-600% returns. And then it has a bad week and loses 7-8-9%. And they have to face that decision of, what if it goes down 50% and I lose all this money I've made? But what if I sell and then this whole thing reverses? And so there's sort of, some people get paralyzed, but I think a lot of people, if it continues to just, the snowball picks up steam as it starts to unwind, and more people will sell and lock in their gains. And so that's why markets can overshoot in both directions. So that's a very interesting point right now. Is this the tipping point towards people taking money off the table, locking in some great returns? But then where does that money go? Well, what's the cheapest beaten up area of the market in light of now a prevailing view that the Fed is going to cut by the Russell 2000?
All right, our first topic for this show is around the attempted assassination of Donald Trump last weekend. The geopolitical risk is really starting to heat up. As portfolio manager, Adam, how do you take that into account given the events last weekend?
Look, I think you have to. I mean, obviously, an attempt on Trump's life is a terrible thing. Whether you support him, whether you want him to be president again or not, that shouldn't happen. If he's not president, it should be because he loses the election, not because of something like this. Putting that all aside to just discuss how the ramifications on the market, I think you have to put it in the context of everything that's happened in the past, month. The debate, then the attempt on his life, and just the how that's moved the needle in terms of the market's view on who's going to be the next president and what are the ramifications of that. And now you've got a lot of discussions. Well, Trump might be harder on China. So what does that mean? That's part of why semiconductors are selling off this week, a fear that there could be increased, tariffs, sanctions, whatever. And so you have to take that all. It's not just the attempt on his life. It's this whole context of what's happening politically. All that said, historically, who wins the election doesn't really matter that much for the overall market. I don't believe in making large bets, large swings, big portfolio moves based off of who I think is going to win. But at the same time, you do have to, on the margin, incrementally think about which party might win, who the candidate is, and what's the rhetoric they're suggesting about different companies, different sectors, who's hard on pharmaceuticals, who's going to lift regulations on banks, and that all factors in, but it all kind of evens out in the end, I think, over time.
I think investing based on political views is a loser's game, but we are seeing a lot of people swing the markets based on their views of what's happening in the election. So when you saw Biden have a really poor showing at the debate, all of a sudden green energy stocks traded really poorly, like extremely poorly. And you saw some of the healthcare names do really well. And that's because people are making these binary calls based on who they think is going to win the election. And if anyone is sitting in the audience right now and thinks that they have 100% certainty on what's going to happen with the election, I would challenge you to, even if you had 100% certainty on what's going to happen, to tell me what's going to happen with the underlying stocks based on the election. Because one thing that we do know is that politicians tend to lie, right? They actually make all these promises when they're in the in the stage of trying to bring voters to their side, and then when they actually get elected, the follow through is very low. And so people right now are trading based on some like comment from Trump that there's going to be a 60% tariff on China. Think about that. All the consumer goods that people buy are going to have a 60% tariff on them. How's that going to impact your daily life? How's that going to impact inflation? Is that likely to happen? Probably not. And Trump has a track record of saying things in the pre-election stage and then executing on them differently once he's elected. So I would just be cautious of making significant changes to portfolios based on political rhetoric going into an election.
Adam, politicians lie.
That's news to me. I'm really going to have to change my view on it. That's crazy. That doesn't happen in Canada. They tell the truth.
Yeah. All right, our next topic is around inflation. For longtime listeners of this podcast, guys, I feel like we talk about this at least every other episode. It's been an issue for a while. Austin, you and I were talking this weekend. Treasury markets are signaling potentially there's more inflation on the way. What do investors need to know?
As a resident gold bug, do you have any thoughts on this one?
Well, I happen to think there's a lot of inflation out there, and there's a lot of misunderstanding around inflation, between inflation and what disinflation is, and understanding that in the context of investing. People are hurting at the grocery store, but how is it going to impact their portfolios?
I think so one of the ways that we think about inflation is we look at the interest rate market, and you can look at the steepness of the yield curve and kind of get an indication of what people are expecting for future growth. One of the things that we've heard over the last couple of days is, there's a steepening of the yield curve. It's false. There's no steepening of the yield curve. It's flattening from a deep inversion. That's not steepening, right? So it basically means people are not expecting negative growth going forward. They're expecting, maybe something that's a little flatter. Now, maybe that is going to continue, and we're seeing the beginnings of a trend that are going to create a steepening of the yield curve. And that would be something that we should really keep an eye on. If we do get 60% tariffs on everything from China, the yield curve is going to get really steep, right? Because everything is going to cost a lot more, and you're going to have to get paid for lending money in an inflationary environment. But from what we can see on the underlying data, which is historically the bond market moves before equities, what we can see from the steepness yield curve, it doesn't appear as though there's much inflation expected today. But that could change based on what happens in the election and then what happens with policies following the election. It could also change as we see the Fed pumping more money in the economy by reducing short rates, which is expected to happen here in the coming quarter or two.
Also, you got to remember that prices won't ever actually come back down, right? Like inflation slowing means prices continue to go up at a slower rate, right? It's the difference between inflation, deflation, and disinflation. And deflation, prices actually falling, very, very rare. What the Fed's talking about is trying to get inflation back to 2 to 3%, which means prices still go up. So if the price of eggs is at a prohibitively high level for the average American consumer, it's not going to go back down. It's just going to go up at a slower rate, right? And you have to remember, it's like when you have a crush on that cute girl and you take her to Whataburger or whatever you go, right? And then the next day you take her to like a 5-star restaurant. You go to like Panda Express or whatever, and you can never go back to Whataburger, right? If you want another day, you don't necessarily have to go up to like a better restaurant, but you're going to stay at least at. My point is that Panda Express got robbed. There, you get it.
That's awesome. Let's talk about rate cuts. All right, so there's a lot of dogma around rate cuts. When the internet bubble collapsed, Greenspan came out to help put some support into the economy, lowered rates. When the great financial crisis came, Bernanke came in, lowered rates. There's an expectation of lower rates doing things to the stock market that are probably already priced in. Austin, how should investors look at that today?
Well, so right now, the betting markets, which is news to me that people actually bet on how many times the Fed will reduce rates, it's completely backwards if you ask me. It just doesn't make sense. Like, you can bet by buying treasuries or selling treasuries, but they have a market in it for gambling. They're saying they think the Fed's going to reduce rate 3 times this year. There's only 4 meetings left this year, and one of those meetings has already been labeled as off limits by the Fed for reducing rates. So that means that they'd have to reduce rates every single meeting post the July meeting, which seems very unlikely. I think based on the current market reaction. There's been they're overplaying the rate reduction. And it's not necessarily going to have as much of an impact as the market is currently indicating. We think it makes sense to wait for some of this noise to kind of settle down and then reevaluate the situation, figure out what the yield curve's telling us, figure out what valuations look like, and then make our way back into the market rather than making a knee-jerk reaction based on an emotional response to comments that Jerome Powell's making in front of Congress, or the fact that someone tried to shoot a former president who's running for election again. So we think there's a lot of noise in the market right now that's generating some emotional tension that's driving equity prices, and that's probably not the best environment to be investing into.
Yeah, there's also, the analogy I always thought of with the Fed was that the Fed has these tools like rates, where if they lower rates, it's like they're pushing on the gas pedal for the overall economy. If they raise rates, it's like they're pressing on the brake. But it's not just rates, it's also their balance sheet, right? Because in the global financial crisis, the Fed ballooned its balance sheet, bought a ton of U.S. treasuries, and right now they're also shrinking the balance sheet. So there's also a scenario where they lower rates and that gets all the headlines. So they're pushing on the gas, but they're also shrinking their balance sheet, which is having the opposite effect. It's pressing on the brake. So they're pressing on the gas pedal and the brake at the exact same time, and the net effect is nothing. But the headline says rates came down 3 times this year. Yeah, but did they actually, a net, was there any overall impact on the overall economy that's going to have an impact on GDP growth? And the answer might be no.
Yeah, and Austin brings up a good point for any of you younger investors out there. These betting markets are not great tools for making decisions in your investment portfolio. It's just people gambling on an app. Don't make investment decisions based upon the gambling markets.
Now flip a coin.
Sorry. Next topic before we start getting to some questions from the audience here. You're both former Goldman Sachs bankers, portfolio managers, and now we're in the middle of some pretty significant bank earnings reports. What's your take so far this earnings season on the banks?
They look pretty good. Like the big money, yeah. Woo! Some of a lot of the big money center banks have reported. The stocks have done well on the back of those reports as they've given guidance on net interest income through the rest of the year. And what's interesting to me about that is, net interest income is, of course, the interest they're earning versus their cost of money, which is essentially rates. And so it's almost, they have to have a view on rates or have hedged them in some way to really lock in what they think their net interest income is going to be. So whatever they're saying in these earnings reports, if rates move in a way that they haven't predicted, it could all kind of not be true. But right now it suggests that the economy's doing well. They're not taking huge loan loss provisions, which suggests the consumer is still holding in there. And it's full speed ahead at the moment.
Yeah, I have a slightly different view. Banks, the stocks traded kind of wonky coming out of earnings. So they did well when the entire market started to raise. And I think that was more of this call it dash for trash or a value trade. But when they actually announced earnings, we talked about this earlier, the stocks traded off for the first few hours. And a lot of it comes down to quality of earnings. And when we think about bank quality of earnings, there's kind of 2 different places that banks can get their earnings from. One is a very consistent business that repeats year after year, which is the net interest margin business that Adam was talking about. You make a loan, you're going to make money on that loan for the next 3, 5, 10, sometimes even 30 years if you're lending on mortgages. And that's a very stable business until the economy starts to run south. And that business is doing fine. It's expected to hit some headwinds as, interest rates are a bit less stable. The business that's really driving earnings right now is a bit of a lower quality business. It's the investment banking business. So I think that Goldman and Morgan Stanley came out and they said their banking business was up by, anywhere between 30 and 50% year over year. And it's great to see that economic or that cyclical business doing well, because it means that we're seeing some of the gridlock in transactions start to ease. But there's just not as much of a value or valuation placed on those earnings because you have to go and actually, you start from zero every quarter when you're looking at transaction-oriented earnings. And so the market places a lower multiple on the earnings that must be regenerated each quarter than they do on the earnings that are consistent and recurring. And so even though they're doing amazingly well on the investment banking side, the market isn't necessarily giving them the credit for it because they think next quarter could be a tough quarter. So it's trying to figure out, like, are they quality earnings or are they the lower quality earnings? And then what valuation should you put on those earnings? And I think the market's still trying to figure that out right now.
I think there was a fear that the banks were going to be worse.
Yeah, for sure.
Which is also, that's another thing, how to disentangle and understand the stock reaction to earnings is what were the actual expectations. And not just, the EPS estimates were $2 and they did 205, so it's good. It's more of that's a collection of, Wall Street research estimates and the consensus. But what did people really think is sometimes a very different number, or people expected it to either exceed that. Particularly like when you have when everyone's very bullish on something, you expect it to beat, and it only beats by a little bit. It should have beat by more, or you expect it to, the opposite can happen as well. So it's hard to untangle it. So maybe quality of earnings is a good way to think about it. But I think there were people that were very worried that the bank earnings would show that the consumer is starting to crack, and as of yet, I don't think that that's come through. And of course, earnings are also backward looking. So where we sit exactly today is not where we were 3 months ago. So we're always trying to catch up to what reality actually is.
All right, let's take our first question from the audience. If you have a question, raise your hand. Manav will come over with the microphone. And while Manav's looking out there for our first question, Adam, you're a comedian. You've got a show right now on YouTube. Where could people go and watch the show?
You just said it's on YouTube.
Yes, I gave it away. We're on YouTube. What should they look up on YouTube?
You can just search my name, and it'll come up.
All right, let's go to our first.
I appreciate you trying to serve that up. That was so nice of you to promote the YouTube special, Adam Muller comedy on YouTube. You can check it out, and parental warning advisory.
Yeah. All right, Manav, do you have our first question?
Everyone hear me? Perfect. Please state your name, which office you're based out of, and your question.
Absolutely. My name is Hayden Baker. I'm out of our Austin office here. And my question for y'all is, outside of investment banking that you said has been doing pretty well as of late, what are some other areas or sectors that y'all are paying attention to that just has you excited that maybe the typical advisor just isn't paying as much attention to?
Austin, I think the spirit of the question is, what sectors have your eye today?
Yeah, I think the energy sector has had our eye for some time, mainly because it's a really good supply and demand story, as people have looked at green energy as being a good substitute for carbon-based energies. The issue is green can't catch up with the global demand for energy. Healthcare is a sector that's been really beaten up because of some of the policies against this sector that we've seen out of the current administration, and that could change. So it's really interesting. We think that semis have a ways to go on the upside, mainly just because everything that people do, I'd hate to guess how many chips there are in this room right now between the microphones, between everyone's phones and their iPads and the TVs, and just everything that we do in society is turning into more of a chip or semiconductor driven operation. So we think that there's a pretty significant tailwind there. So I don't know, what other sectors are we kind of thinking about?
Well, one thing I say is we often talk not in sectors, but we'll talk themes, and often those themes are across different multiple sectors, right? So we spent a lot of time over the last couple of years talking about AI, of course, right? And there's the obvious sort of chip play, but then there's the energy required for the data centers to actually use the chips. Are there end users that will implement AI in a way that could dramatically either decrease their cost structure or or help their revenue growth or things like that. So sometimes, the other things we've talked about is the sort of Ozempic weight loss drug theme. And, obviously that has a huge impact on a pharmaceutical company that has the product. And right now, several companies are testing. Right now, it's an injectable, which is annoying for a lot of people. They don't want to stab themselves repeatedly.
They can't even not eat a cheeseburger. How are they going to stab themselves?
But that's a good point.
You might need a comedy special, Austin. Look at that.
You just hold the cheeseburger and then you. But whichever pharmaceutical company comes up with the pill form that works for that Ozempic type drug, that's going to be a home run. I think it was today or yesterday, Roche, the company, announced positive data on some phase 1 study with like 24 people, took their pill of Ozempic and didn't die, and the stock went 7%. But that's the kind of thing. It's like, well, that's a theme where it's like, that's exciting for a pharma company that figures that out. And then what's the impact on snack companies? Like, are people going to eat less chips because they're, and the market thinks maybe they will. So there's things like that. We do talk a lot about themes across sectors.
From the themes, it's a good point. So themes that we really focus on the AI side, utilities are something that we've been on for a long time, mainly because with AI, there's a significant increase in electricity usage. It's actually going to be growing probably at some positive multiple of GDP instead of a fraction of GDP, which is what it had done over the last decade plus. So we think valuations are a little low for utilities while they still have really consistent high single-digit growth, which is a good story. We also like this reshoring theme and, referencing the fact that a lot of tariffs are being rumored. I think both political parties have an incentive to bring production or manufacturing back to the U.S. So it's what companies are going to benefit from, bringing production back to the U.S. It's going to be infrastructure companies. Some of the chip manufacturers are getting tens of billions of dollars to build new fabs in the U.S. So it's really trying to focus on, as we see, the government's been dictating where money's been invested for the last 3 or 4 years, probably since 2020. They've been dictating a lot of the capital investments. So it's focusing on where they're putting money. And those tend to be the winners in society today. If that changes, we'll make an adjustment, but we're really focused on where that money's flowing.
Yeah, infrastructure was another sort of theme / sector we've talked a lot about. The government spending a lot of money paving roads and, bridges, airports, whatever. And who benefits from that?
Next question. Looks like we have some up here, Manov.
Perfect. All right. Please state your name, which office you're based out of, and your question.
My name is Matthew Williams from the Houston office. My question was with regard to blockchain. It's a fast-growing technology, and I was curious where you guys think we'll see it in our daily lives, and as well as it's used more, the issue of scalability really comes up, and how, especially with layer ones, and how would that be addressed?
Excellent, guys. I think the spirit of the question, which we've received before on previous podcast submissions, is how should we look at blockchain and crypto when we build diversified portfolios?
Yeah, I think that, so for one, I think blockchain is a technology that has a lot of application in the economy, anywhere from supply chain all the way to the crypto application. I think blockchain's got legs. The issue is like how it's going to be incorporated and how that, like you hear Jamie Dimon talking about blockchain and how they're using it at JP Morgan. From the crypto side of things, I think most people talk about blockchain and crypto in the same sentence. From our perspective, it's really hard to come up with a solid view on crypto because there's just not enough data, right? Like crypto's only been around for a decade and a half. We like to see much more data when we're making investment recommendations for client portfolios. So what we would tell people is if you're really excited about crypto, is it's okay to invest in crypto. It's going to be a bit more speculative in nature just because there's not enough solid data to base your decision off of. And so with that in mind, you need to size it appropriately. So we would recommend if clients want to invest in crypto or trade crypto, I'd be hesitant to call it investing in crypto at this point. But if you want to trade crypto, keep it in what would be more of like a very small sleeve that is more of like a lottery ticket portfolio that people can kind of invest in their own high flyers and kind of take different bets on, but not look at it as like a tremendous creator of value, because it tends to be one of those asset classes that can be boom or bust. And if you're in the bust side of it, you're going to feel really bad if you had a significant amount of your net worth invested in it.
Yeah, I think I look at crypto very simplistically, which is if you have a bunch of friends that own crypto, and if they get rich, it's going to really bum you out. Own some.
So it is.
Profound.
Yep.
Yep.
Yeah.
And I should say with full disclosure, I own some because I have some friends, and if they got really rich and I didn't, I would be very bummed out.
Well said. Myself as well, Adam. We have time for one more question. Manav?
I gave the mic up.
Raise your hand. I saw a bunch of hands go up. We just got to pick one, Manav.
All right, let's go with the Houston crew. Please state your name, which office you're from, and your question.
And your social security number, your mother's maiden name, the house you grew up on, and your pet's first name. Thanks.
I'll get right on it. I'm Austin Thompson out of the Atlanta office, and I've gotten a lot of feedback over the past 2 or 3 years that investors have been really scared to invest in even developed international markets, just given how much they've lagged U.S. markets. So just given that there's quite a bit of QE going on, do we see any evidence of a softening dollar? And does that mean that we should be maybe going a little bit more overweight into international equities?
So the spirit of the question is great for this audience. This is the team that ran the international suite of dividend mutual funds at PIMCO. Gentlemen, what's your take on international investing today?
I think it's interesting because if you look at the global and international indices, right now the U.S. is about as big a percentage as it's ever been, depending on if you're looking at the ACWI, which is, emerging markets and international markets are just MSCI World. They're anywhere between, U.S. is anywhere between 65 and 75% of those indices, meaning that almost everyone's investing in the U.S. And it makes sense because we have a handful of companies that are basically succeeding in a winner-take-all market. And so that's crowding out not just all other U.S. companies. You've probably heard of the 493 companies that aren't in the Magnificent Seven. Well, think about the rest of the world. There's a ton of opportunity in the rest of the world at really attractive valuations. The issue that we've had up until more recently is that those valuations weren't supported by earnings growth or earnings growth potential. One of the things we're seeing is that as global central banks are thinking about reducing rates, they're flooding money into their own economies, which is pushing growth to these companies that are currently trading at tremendously low valuations. So we think there's a lot of opportunity in international markets. We do consider an overweight international to be supportive of long-term portfolio returns. With that being said, we're not going 50% into international portfolios because these trends tend to last much longer than anyone ever expected them to last. We're starting to see, as Adam mentioned in the beginning, the canary in the coal mine that might be ending, but we don't want to put all of our eggs in that basket yet.
But the same way you saw the Russell 2000 last week just start make up some of that lost ground, it would not surprise me that at some point in the next 4 to 6 months, we're looking at some similar chart of, some international index versus U.S. markets. So on the margin, I don't think it's a bad time at all to start incrementally increasing international exposure. And in a true diversified portfolio, you should have some ex-U.S. investments. That said, I think generally, if you live in the United States, the bulk of your retirement should be, U.S. dollar denominated investments. But to be truly diversified, you should have some international. And it's a good time given relative valuations, to start thinking about sort of slowly, incrementally increasing that. All that said, I never really have made an investment decision by guessing where the US dollar is going to do, because I think that's just there's just so many different factors, although I guess rates are really the one that are going to dominate right now. But valuations, I think, to me, are more interesting than like my 6 to 12 month view on the dollar.
All right, gentlemen, great show. Viewers and listeners, to learn more about Opal Capital, please visit opalinvest.com. And thank you to the 49 Financial audience.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.